Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I'm going to be going into a really important topic. Is the United States Treasury manipulating interest rates? It's something I have been talking about for many months now, but finally, we actually got a paper with some really concrete evidence that this is in fact happening. So I'm going to talk about this paper here today, and then I'm also going to talk about a kind of an article on CNBC that featured this paper. So let's go to that first. So this is what basically got me tuned into all this about 2 weeks ago. So this was an article that was published on CNBC called Kelly Evans, Is Treasury Manipulating Interest Rates? And now this is based on a paper that was put out by Stephen Miran and Nouriel Roubini. Now, everybody, I think most people know who Nouriel Roubini is. He's famous for writing his book, Black Swan, which was a huge national bestseller and really kind of changed in a certain sense, maybe pop culture sense, in terms of how we look at, unanticipated events, economic events that happen in the economy. So obviously Nouriel, a very famous economist at this point. So, but what did they do? So they basically put in here, it says here, we're all used to debating whether the Federal Reserve is manipulating interest rates. What's new is the allegation that the Treasury is now doing so. So to be clear, this isn't new to many market participants who have been debating this issue for months. Right here. But it's now getting broader public attention thanks to a recent paper by Nouriel Roubini and Stephen Miran, which argues that by adjusting the maturity profile of its debt issuance, Treasury is usurping core functions of the Federal Reserve. They even warn that these political business cycles could result in higher long-term inflation and interest rates. And this is exactly what I was talking about in some past episodes, that this manipulation by the Treasury has become political, and that this is basically going to result in longer, higher term interest rates for us down the road. And we'll get into all that in a minute here. So just kind of bear with me here. So this is short. So let's just kind of hit this first, and then I want to go right to the paper. So it is definitely true. The Treasury has been leaning heavily on issuing short-term Treasury bills lately, which have also carried the highest interest rates. Few want to see Treasury paying upwards of 5% on short-term borrowing when our debt load is so high that such interest payments are now larger than spending on Medicare or defense. Now, let me read that again. Few want to see Treasury paying upwards of 5% on short-term borrowing when our debt load is so high, meaning our national debt of $35 trillion, that interest payments are now larger than spending on Medicare or defense. Okay, we're spending over $1 trillion just on interest payments on the national debt. So, but there is a fundamental case to be made for tilting towards bill issuance, as I think I'm saying her name right, Gennady Goldberg explains to Axios. Treasury is trying to prevent a full-blown bond market meltdown that could result if they issued more long-term debt than the market could handle, i.e., Japan and China aren't buying our long-term national debt anymore. Okay, they're not buying it. They're out of the market. Okay, so which means that the U.S. has to find other buyers for that. There's not a lot of willing buyers out there because of our inflation, because of the perceived riskiness now in our debt. So therefore, you can't sell those longer term bonds. Like that's the crux of everything that's getting here. Our government, as I've said so many times, is spending money, spending us into oblivion, basically. And they can't sell the long-term national debt anymore. And so they're playing these games to basically, okay, we'll sell the short-term T-bills because nobody wants to buy the longer-term stuff, but we also want to keep the yield curve inverted because we're trying to prop the economy up so that it doesn't collapse, because we're trying to get, Biden-Harris administration reelected. That's basically what's going on here. Plus demand for bills, T-bills, the plumbing of the financial system is much higher right now as the Fed drains its reverse repo facility, and they don't want to create a shortage there that could result in a credit crunch. So, and there's a whole nother conversation there. So I've talked about the repo facility in the past and how reverse repo contracts are coming down. Now, why does the Fed want to get rid of reverse repos? Well, because they're losing their butt on reverse repos. The Fed has lost billions of dollars. The Fed is losing billions of dollars for the last year or so. And so they are trying to drain out the reverse repos to try to limit those losses. So there's a whole bunch of basically wacky things that have all led us to this moment here today. But let's see here. Taken together, Roubini and Miran posit the Treasury has probably kept long-term rates about a quarter point lower than they might have been otherwise, which they call a backdoor form of quantitative easing. And I'm going to explain that in a minute. So again, just hang with me as we get into the paper here, because we're going to put quantitative easing and then what the Treasury is doing side by side, and we're going to see how this looks. But as interest rates plunge, those concerns will recede. Indeed, a former White House economist, Ernie Tedeschi, notes the bill share of total securities is about 21% right now, which used to be the norm pre-financial crisis. Now, we're going to see that's BS. And we're going to see here in the paper, at the end of the paper, they go through, here's a number of ways that are basically, it was genius the way they did this. They basically put the paper together and said at the end, before they issue their conclusion, they go, okay, here's all of the rebuttal arguments that we're going to get from both the Fed and the Treasury as to why, basically saying our paper's nonsense. And they address each one of those. And this is exactly one of the things that they address. Moreover, this is exactly the strategy a fiscal agent might take to save taxpayers some money if they expected rates to fall soon. Oh, thank goodness. Thank goodness. I thought, the Treasury, might have been doing this for, their own sake and political reasons, not to, help the U.S. taxpayer. But anyway, imagine if Treasury had issued more 10-year debt last year, for instance, when those yields surged above 5% versus now when they are back to 3.8%, whereas the 3-month bills they issued at high yields last year will quickly roll over now to less costly ones. Yeah, I don't think so. So yes, Treasury is manipulating rates through their issuance changes, but their decisions are justifiable based on market conditions and may even prove deft if they can eventually lock in lower long-term borrowing rates. The tougher decisions that could really improve borrowing costs will ultimately have to come from other buildings in Washington. And that is what you called wishful thinking. So the Treasury is without a doubt manipulating the interest rates, and this has become a political thing. And there are going to be serious ramifications to this. And like I've said before, what's going to happen is you are going to see the Federal Reserve is going to start to reduce rates next year, and you're going to see the 10-year T-bill go up. What is your mortgage rate tied to? Oh, that's right. It's tied to the 10-year Treasury. So what's going to happen is as the federal funds rates going down, the 10-year Treasury is going to go up, and that's going to keep mortgage rates high, and people are going to be shocked when they see this. So now, hold on a second. So here's the actual paper itself, and this paper is called ATI Activist. That's a key word there, Activist Treasury Issuance and the Tug-of-War over Monetary Policy. Now, before we get to this, just 1 second real quick, I wanted to show everybody. So this is the yield curve. This is from the Fed. This is from the Fed, the St. Louis Federal Reserve base. Now, this is the Treasury yield curve here. Now, as I pointed out, this is over the last year. 1%, the black bar, 1% here at the top, that's basically break even. Okay, if we go above zero, we're getting back into positive territory. We've basically been in negative territory here for over 2 years. We've had what's called an inverted yield curve, and this is not normal. This is basically the longest and deepest yield curve reversion that we've ever had in history. Is not normal, and it shouldn't be this way. Now, here's the key things here, because we go back to October 25th of 2023, because that's when this manipulation really kicked into high gear. So you can see here that the yield curve was about to revert back. Now, people say that the yield curve is a great predictor of recessions. Yes, it is. Is it a perfect predictor? No. Is it like 95% accurate? Yes, it is. Now, when does the recession hit? It hits when the yield curve reverts back to positive territory. And usually within 6 months of reverting back to positive territory, that's when the recession hits. So, if it had been allowed to revert back to positive territory in October of last year, and it takes 6 months for the recession to hit, where would that have put us at? That would have put us at approximately, let's see here, November, December, January, February, March, April. So April, we would have hit like boom. And what would that have done to the people in the White House right now? That would have been bad news for them. That would have pretty much doomed any chance they would have had at getting reelected. So here we have in October. So then this manipulation kicks in. You can see then it comes right back down. But then it starts to break up again in January. So January 25th, here we are again, January 25th. It's getting ready to revert back to positive territory. Oh, no, not so quick, not so quick. We're going to pull this sucker all the way back down here to June 20th here. And then we see this spike up. What happened? As I reported, if you saw my episode on the Japanese meltdown, that's what happened here on August 7th, August 8th. And that almost put it back to positive territory again, but then we get pulled back down here a little bit, and so I say this to give context as to like what is happening here. Okay, so let's take a look at this paper for a second. So and we're not going to, again, I'm not going to kill everybody in dramatic detail going through this whole thing. There's links to the article and the paper in the description below if you want to go check it out and look at the whole thing. But I just want to try to hit some of the highlights here. So by adjusting the maturity profile of its debt issuance, Treasury is dynamically managing financial conditions and through them, the economy, usurping core functions of the Federal Reserve. We dub this novel tool activist Treasury Issuance, or ATI. By manipulating the amount of interest rate risk owned by investors, ATI works through the same channel as the Fed's quantitative easing program. So we're going to look at that in just a second. ATI has been a major market driver over the past year, and we expect it will continue to play a significant role in the years ahead. ATI may become a regular element of the policy toolbox, driving political business cycles in the market and the economy. So what do they mean by that? They mean that basically this administration is using it, and it's become an effective tool now of the Treasury. And so therefore, future administrations will then begin to use this abuse or manipulation as a tool, So we calculate that ATI has reduced 10-year yields over the last year by roughly 0.25%, providing similar stimulus as a 1 point cut in the federal funds rate. A 1 point cut. So that's 100 basis points. 1 point cut. So the central bank's primary policy tool. Combined with higher neutral rates, ATI implies the total stance of both monetary and issuance policy considered together is roughly neutral. In other words, ATI has interdicted the Fed's attempt to restrain the economy, helping explain inflation persistence and upward nominal growth surprises over the past year. In other words, this is what has kept inflation up. This is what has kept price inflation up, is this manipulation by the Treasury. If ATI is unwound via terming out 1 trillion of excess Treasury bills, we expect it to temporarily boost 10-year yields by 50 basis points before settling into a permanent 30 basis point increase with corresponding price changes in risk assets. A 50 basis point increase in the 10-year yield will have similar economic effects as a 2-point hike in the federal funds rate. And this is exactly what I was just saying about how the 10-year Treasury, the long-term yield, is going to go up as the yield curve reverts back to positive territory. This is going to go up. It's going to force long-term interest rates up. They are going to need that, because in order to get countries to start buying our long-term national debt again, they're going to have to pay higher interest rates on that. If ATI is not unwound, but becomes a permanently employed policy tool, we are likely to see higher equilibrium inflation and interest rates priced in over time due to political business cycles becoming reality. And that's, I mean, it's just, I mean, this is horrible. I mean, this is basically as horrible as what it is. Okay, so let's go down here. So then it has this whole introduction. So let's read some of the highlights here. So ATI-induced accommodation has loosened the combined stance of monetary and issuance policy. Contrary to the Fed's insistence that monetary conditions are quite restrictive, they are not. And Treasury's issuance policies help explain the persistence of inflation and strong economic growth. In other words, this is the stimulus that has kept the market rolling. So let's keep on going down here. Whereas QE worked by removing interest rate risk from the market and hiding it away on the Fed's balance sheet, ATI works by limiting the production of interest rate risk at the source. The net effect, however, is similar. And it gets into how ATI drives liquidity and financial conditions. And now here's the key thing. This is what I wanted to show you, the comparison of quantitative easing and ATI. So we can see from basically on the left-hand side here, it breaks it down by transaction, portfolio managed channel, money supply channel, bond market effects, risk asset effects, and then political economy framework. And you can see a lot of these are similar. So QE, the Fed buys the intermediate and long-term debt, creates overnight reserves, money. The Treasury auctions less intermediate and long-term debt, auctions more short-term bills, i.e. short-term Treasury bills, quasi-money. So then you have the portfolio balance channel. So the Fed removes interest rate risk by placing it on the Fed's balance sheet. However, the Treasury reduces creation of interest rate risk at issuance. The bond market effects. Bond prices are higher than they otherwise would be. ATI, bond prices are higher than they otherwise would be. Risk asset effects. Other asset prices are higher than they otherwise would be. ATI, other asset prices are higher than they otherwise would be. You're starting to see the pattern here. Political economic framework, politically independent in principle. Central bank managing the business cycle via financial markets. ATI, politically dependent Treasury officials managing the business cycle via financial markets. So you can begin to see how similar in a certain respect QE and this new proposed ATI are. So now, and then it gets into the size of the Treasury stealth QE. And and let's just go on. Let's just keep going down here because I want to get to the bottom here. And then it gets into, I mean, this paper really is phenomenal. I mean, I really highly recommend people go through and actually read through this paper to understand what's going on here. And then it gets into the, political business cycle. So our greatest concern is that regular use of ATI will push us into a world of more volatile political business cycles of the type studied in Alicina, Roubini and Cohen from 1997. So there and again. So our greatest concern is that the regulatory use of ATI will push us into a world of more volatile political business cycles with higher equilibrium, inflation, and interest rates. Yes, I think that's a huge unwinding ATI will temporarily lift long yields by 0.5% before settling into a permanent 30 basis point increase. Debt limit considerations. Okay, they get into like buybacks. Okay, now here's the interesting criticisms of the ATI view. We imagine there are several criticisms of our argument that officials or analysts might make from the Fed. QT is not monetary policy. And then they refute this. And then going in, now here's the ones from the Treasury. Issuance is in fact regular and predictable. That's what the CNBC article was at the end of the CNBC article. That's what they were trying to say, that, oh, hey, this is all normal. This is all normal. There's nothing to see here. We're in a normal bandwidth. It's like, no, this is not normal. There's nothing normal about this. Again, from the Treasury, the bill share is only a few percentage points above 20%. And then further, the bill share has always varied over time. And then finally, focus on WHAM, not the bill share. And WHAM is within historic norms. Again, this whole argument from the Treasury that, oh, hey, you're just exaggerating here. This is all normal. Nothing to see here. Nothing to see here. And then from analysts, why haven't markets priced in the terming out of excess bills? So in other words, oh, if this was a real concern, the markets would have priced this in. And then they get down to the conclusion here. So new issuance patterns by Treasury have deviated from regular and predictable auctions in a manner that exerts heavy influence on financial conditions and through them the economy, i.e., they're propping the economy up. We dub the use of varying issuance patterns for the sake of managing financial conditions activist Treasury issuance, or ATI. Drawing on a range of empirical economic studies of monetary policy, finance, and fiscal policy, we calculate the ATI has reduced long-term interest rates by a quarter point, providing similar economic accommodation as a full point reduction in the Fed's overnight policy rate. Combined with estimates of the neutral policy rate drifting higher, the joint stance of monetary and issuance policy is roughly neutral. The Fed isn't providing meaningful economic restriction, contributing to inflation persistence. However, we expect the surfeit of bills to be termed out eventually when the market starts to look forward to over $1 trillion of bills being termed out into notes and bonds. We expect it to temporarily raise long-term interest rates by 50 basis points, prompting a meaningful repricing of risk assets before settling back into a permanent 30 basis point increase. Now, remember what they said earlier, a 50 basis point increase would have the same effect as a 200 basis point increase in the federal funds rate. The use of ATI to manage financial conditions in the economy into election season is a dangerous precedent that opens the door for material political business cycles in the United States. It threatens to raise long-run inflation and interest rates over time as future administrations make use of the same tool. Frequent use of QE since the global financial crisis has shown a light on the eroding barrier between monetary and fiscal policy and opened the door for tools like ATI. The interaction between policy choices from the Fed and Treasury will remain a fruitful area of study for the market participants, policymakers, and academics. That it will. And that last part there, frequent use of QE since the global financial crisis has shown a light on the eroding barrier between monetary and fiscal policy. Yes, and if you follow if you went through my series on the Lords of Easy Money, we talk about that in depth. So definitely go check out the Lords of Easy Money series. So what do we have here? We now have an incredible paper here, an absolutely incredible paper that basically lays out that the Treasury has in fact been manipulating the T-bills, they've been manipulating the yield curve, and they've been propping the economy up, and they've been doing it for political reasons. That is without debate now. Even CNBC admitted in their article here that basically they said, if I go back to that, I know you guys can't see that. They said right here at the end, Treasury. So yes, Treasury is manipulating rates through their issuance changes. So this is undisputable at this point. I mean, it is happening. This is what the Treasury is doing. And I fear, exactly as Stephen and Nouriel are saying here, that this is this is definitely a very, very troubling thing. There are political ramifications here. We have monetary ramifications here. We have fiscal ramifications here. And again, I mean, just this constant, and that's kind of the whole point of the book, The Lords of Easy Money. It's this constant manipulation by the Fed, and now we have the Treasury. Whereas, the Fed is telling us that monetary policy is very restrictive right now, when in fact it's not. It's just maybe the Fed is being restrictive, but the Treasury is picking up the Fed's work basically for them. So, again, this is just it's highly disturbing, and this is going to have dramatic ramifications on our economy. And you mark my words, we will live to regret the decisions here of the Treasury and this manipulation and the things that they have been doing over the last year and a half. The roosters will come home to roost. Anyway, but I'm going to wrap up with this. I'm doing another episode here that's going to be coming out. So you got this episode today. The next episode tomorrow is going to be about basically the BLS job numbers. So I want you to think about this episode and the next episode in context, and then I'll be talking about these in the live streams that I'll be doing on Sunday when we do kind of our weekly banking update in the strategy room. And so again, you have to kind of look at all these together. And when you see all this as it comes together, that's what's going to make a big impact on the way you think about the economy and a lot of things that are happening in the economy at the moment. So, okay, if you like this episode, please make sure to like, share, and subscribe. Please remember we are on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below. I would really love to hear people's feedback on this one. And like I said, I will be back real soon with more episodes. And please check out the live streams this weekend. Thanks a lot.